Hi everyone. In the first four chapters, we learned some basic tools that we can use to make an economic analysis. But starting from this chapter, now we go through the macroeconomic variables, the main ones. We start with the GDP. GDP is gross domestic product, and it helps us measuring a nation's income. So think about yourself when you finish school and start looking for a full-time job. Your experience will be shaped by economic conditions. In some years, firms are expanding their production of goods and services, employment is rising, and jobs are easy to find. But in some other years, firms are cutting back production, like what happens during the recession. Employment is declining, and finding a good job takes a long time. And not surprisingly, any college graduate would rather enter the labor force in a year of economic expansion. Because the health of overall economy affects all of us, changes in economic conditions are widely reported by media. Indeed, when you check the newspapers or online news services or turn on to TV, you will see a lot of reported statistics about the economy. Like the statistics might measure the total income of everyone in the economy, like gross domestic product that we learn in this chapter, or the rate at which average prices are rising or falling, or the percentage of labor force that is out of work, unemployment, total spending at stores, retail sales, or the imbalances of trade between the United States and the rest of the world, which is trade deficit. All these statistics are macroeconomics, okay? They are not telling us what the household is doing, but they are usually telling us something about the entire economy. As you recall from chapter 2, divide the economics into two parts. The first one is microeconomics, which is the study of how individual households and firms make decisions, interact with one another in markets. And on the other hand, macroeconomics is the study of the economy as a whole. So, the goal of macroeconomics is to explain the economic changes that affect many households, not one household, many households, firms, and markets simultaneously. So we try to, as a macroeconomist, we try to address diverse questions like why is average income high in some countries while it's low in others? Or why do prices sometimes rise rapidly while at other times they are not? As you see, these questions are all macroeconomic in nature because they concern the workings of the entire economy. So in this and next chapter, we discuss some of the data that economists and policymakers use to monitor the performance of the overall economy. And these data reflect the economic changes that macroeconomists try to explain. First, we start with the gross domestic product, which measures the total income of a nation, and GDP is most closely watched economic statistics because it's thought to be the best single measure of a society's economic well-being. Let's try to understand first what is gross domestic products, or in shortcut GDP. I'm going to say GDP instead of gross domestic product. It measures the total income of everyone in the economy. If you were to judge how a person is doing economically, the first thing you are going to look at is her income. A person with a high income can more easily afford life necessities and luxuries. So it's no surprise that people with higher incomes enjoy higher standards of living, better housing, better healthcare, better vacation, fancier cars, and the same logic applies to the nations as well. When judging whether the economy is doing well or poorly, it's natural to look at the total income that everyone in the economy is earning. That is the task of GDP. So GDP measures two things at once: the total income of everyone in the economy and the total expenditure on the economy's output of goods and services. So this may be confusing in the beginning, but I'm trying to explain why GDP can measure two things at one time. GDP can perform this trick of measuring both total income and total expenditure because these two things are actually the same. For an economy as a whole, income must equal expenditure. Why this is true? an economy's income is the same as its expenditure because every transaction has two parties, buyers and sellers. Every dollar of spending by some buyer is a dollar of income for some sellers. Suppose, for instance, you buy a coffee from Starbucks. You pay $1.4 to buy a coffee. In this case, Starbucks is a seller, and the money you pay is the income for Starbucks, true, and you are the buyer. $1.4 is your expenditure. Thus, this transaction contributes equally to the economy's income, $1.4 increase in income for Starbucks, and to its expenditure because $1.4 increases the total expenditure of the economy. Another way to see this income equals expenditure is with the circular flow diagram. Next, recall from chapter 2, this diagram describes all transactions between households and firms in a simple economy. And just what you need to remember about circular flow diagram is, first of all, what are factors of production? These are the inputs that you use to produce goods and services like labor, land, capital, and natural resources. And remember, factor payments are payments to the factors of production. Like for labor, what you pay as factor labor, you pay the wage. For land, you pay the rent. Have in this diagram two agents, firms and households. What is the role of the households in this diagram? They own the factors of production, sell, rent them to the firms for income, buy and consume goods and services. On the other hand, firms buy higher factors of production, use them to produce goods and services, and sell goods and services. And it's actually very helpful to understand the general economy. And it simplifies matters by assuming that all goods and services are bought by households and that households spend all of their income. In this economy, when households buy goods and services from firms, these expenditures flow through the markets for goods and services. Look at here, as you see, when households buy goods and services with the green line, dollar as an expenditure goes to markets for goods and services. It's a spending for households. But at the same time, it's a revenue for the firms. Your spending is a revenue for the firms. And in return for firms, the revenue, it's actually pay wages, rent, profit to the households through the markets for factors of production. GDP measures this flow of money. We can compute it for this economy in one of two ways, by adding up total expenditure by households, okay, or by adding up the total income, wages, rent, and profit paid by firms. Because all expenditure in the economy ends up as someone's income, GDP is the same regardless of how we compute it. And the actual economy is, of course, more complicated. We assume only that there are two agents, but households do not spend all of their income they pay, some of it to the government as taxes. And households save some for use in future. That means they put their money into financial system. In addition, households do not buy all goods and services produced in the economy. Some goods and services are bought by governments and some are bought by firms, okay, for future production. But the basic lesson remains the same. Regardless of whether a household, government, or firm buys the goods and services, the transaction has a buyer and seller. Thus, for the economy as a whole, expenditure and income are always the same.